When you're looking at a company, what are the first things you hear about? Revenue, profit, earnings per share, right? But what if I told you there's another number, a number that's way harder to fake, a number that smart investors, I mean the really smart ones, see as the ultimate lie detector? Today, we are talking all about cash flow.
Hey everyone, and welcome. Today, we're pulling back the curtain on one of the most powerful yet often overlooked tools in any investor's arsenal. And trust me, by the end of this explainer, you're going to see how focusing on the actual cash can give you a completely different and frankly, a much more honest picture of a company's real health. Let's get right into it.
And look, you don't have to take my word for it. The legendary investor Charlie Munger put it perfectly. He said, "Earnings can be fudged. Cash flow is harder to fake." This quote, this gets right to the absolute core of why we're here. You see, reported profit is important, sure, but it's subject to all kinds of accounting rules, assumptions, and let's be honest, sometimes a little bit of creative license. Cash flow, though? Oh, it's brutally simple.
So what does that really mean? Well, think of profit as an accounting opinion. It includes things that aren't actually cash, like depreciation. Cash flow, on the other hand, is a hard fact. It's the cold, hard cash that actually moved into or out of the company's bank account. It is, quite literally, money in the bank. It's the lifeblood of any business.
All right, so we get it. Cash is king. But now we've got to break it down, because there are a couple of key types of cash flow that every single investor needs to know. They each tell a slightly different but equally important part of the story.
Okay, first up we have operating cash flow, or OCF for short. This is the cash a company brings in from its main day-to-day business, what it's actually supposed to be doing. For a company like Apple, their OCF in a recent year was over $110 billion. That's the real cash that came in the door from selling iPhones and MacBooks and services after paying for the stuff needed to make and sell them. It's a really pure look at the health of the core business. But then there's the next level, free cash flow, or FCF. And this one's the real tough grader. It takes that operating cash flow we just talked about and then subtracts something called Capital Expenditures, or CapEx. And what's that? It's the money the company has to spend on the big stuff, new factories, better equipment, updated technology, just to stay in business and hopefully grow.
And this is the key difference, right? OCF is awesome. It shows you how much cash the basic operations are churning out. But FCF shows you what's truly left over for the owners of the business. That's us, the shareholders, after the company has paid all its bills and reinvested in itself to keep the lights on. That's why so many pros call it the true owner's earnings. It's the cash that can actually be returned to shareholders through dividends or buybacks.
Let's make this super simple. Imagine you're running a lemonade stand. You have a great day, make $1,000 in sales. Awesome. Now, you had to spend $400 on lemons and sugar, those are your operating expenses. But you also realized your old juicer is kind of slow, so you bought a shiny new one for $200 to keep up with demand. That's your CapEx. So at the end of the day, the cash that's truly free and clear in your pocket, $400. That's your free cash flow. Simple as that.
Okay, so we get the concepts. Awesome. But what do we do with this information? How do we use it to figure out if a stock is cheap or expensive? Well, that's where valuation ratios come in. And we're going to look at a powerful alternative to the famous PE ratio.
I'd like to introduce you to the price to operating cash flow ratio, or just P/CF. This little metric is fantastic. It tells you, very simply, how much you're paying for every single dollar of cash that the company's main business generates. It's a way to value a company based on its raw, cash-generating power.
And the best part? Calculating it is dead simple. Seriously, you just find the current stock price, you look up the operating cash flow per share, it's right there in the financial statements, then you divide the price by the cash flow. Boom, that's it. You've got your PCF ratio.
So you do the math and you get a number. Let's say it's 10. What does that even mean? Well, it's actually pretty straightforward. A P/CF ratio of 10 means you are paying $10 for every single dollar of operating cash flow that company brings in each year. A lower number kind of suggests you're getting more bang for your buck, right?
Which of course leads to the big question. What's a good number here? Is a PCF of 5 amazing and a PCF of 20 just awful? Should we just go out and buy every stock with a super low PCF ratio? Well, not so fast. Like with pretty much everything in investing, it's just not that simple.
The number on its own is almost useless without one absolutely critical ingredient, and that ingredient is context. A PCF ratio only becomes that powerful lie detector we talked about when you compare it to the right things.
Now, we can start with some really broad, general rules of thumb.
A ratio under 8 might signal a potential bargain, maybe in a mature company. Something over 25 usually means investors are pricing in a ton of future growth. But, and this is a huge but, these are just loose guidelines. Don't treat them as gospel.
Because the single most important piece of context, the thing you absolutely have to consider, is the industry that the company is in. Comparing a software company to a utility company using the same PRCF number is a classic rookie mistake. It's like comparing apples to, I don't know, cement mixers.
And this slide shows you exactly why. I mean, just look at the difference. A high-growth software company like Pinterest doesn't need a lot of physical stuff, so it might trade at a PCF of 20, 30, even 35. Investors are paying for future growth. But a big industrial company or a utility that has to constantly spend billions on plants and equipment, their typical PCF range is going to be way, way lower.
Let's make this crystal clear. Say you see Company A, a software firm, with a PCF of 10, and Company B, a manufacturer, is at 6.6. At first glance, Company B looks way cheaper, right? Lower number, better deal. But when you add context, the whole story flips. A PCF of 10 for a software company is insanely cheap compared to its peers. It could be a massive bargain. Meanwhile, that 6.6 for the industrial firm, while low, might actually be a red flag that something's wrong. Context, it changes everything.
Whew, okay, that was a lot, I know. So let's just boil it all down to the key takeaways you can stick in your personal investor toolkit and use right away.
Here's what you need to remember. 1. Profit can lie. Cash flow is much more honest. 2. Free cash flow is the real prize. It's the cash that's left over for you, the owner. 3. The P/CF ratio is a great, quick way to value a business based on its cash-generating ability. And 4, and this is the most important one, never look at a P/CF ratio in a vacuum. Always, always compare it to other companies in the same industry.
So, I'll leave you with a challenge. Go look at a few stocks that you own or that you're following. Look up their P/CF ratio and compare it to their competitors. Do they look cheaper than you thought, or maybe way more expensive? You might just be surprised at what you find when you start following the cash.
Hey, if you found this useful and got some value out of it, a quick like and subscribe would be amazing. It really does help us make more of these explainers for curious investors just like you. Thanks for stopping by, and I'll catch you in the next one.